Something strange happened this week in the stock market. While oil prices spiked above $100 and the U.S. went to war with Iran, stocks actually went up on Monday. The big money wasn't panicking. They were rotating. And that tells us everything about what's really happening beneath the surface. Most people think markets move on news. War breaks out, stocks fall, oil spikes, energy companies rise. But the smart money knows something different. They know that markets move on human behavior first and news second. And right now, human behavior is revealing a dangerous pattern that most traders are completely missing. Here's what actually happened this week. The market had 3 losing weeks in a row. That's the kind of pain that makes people desperate for any good news. So when oil dropped just a few dollars on Monday morning, traders jumped back into their favorite stocks like it was Black Friday. Meta jumped over 2% on rumors of massive layoffs. Nvidia rose on their big AI conference. Everyone piled back into tech stocks like the war in the Middle East was just a weekend inconvenience. But here's the problem with that thinking. The technical damage is already done. Every major index now shows what traders call a death cross. That's when short-term moving averages fall below long-term ones. It's like a warning light on your car dashboard. You can ignore it for a while, but eventually something breaks. The big money understands this. They're not buying because they think everything is fine. They're rotating because they have to put money somewhere. When you manage billions of dollars, you can't just sit in cash and wait. So they move from beaten-down small companies to familiar tech names, from energy stocks back to semiconductors. It looks like confidence, but it's really just musical chairs. Now let's talk about what the system is actually telling us. The Federal Reserve is meeting this week, and everyone expects them to keep interest rates the same. But here's what matters more than their decision. It's what they say about inflation. Because while everyone was focused on stock prices, inflation data came out showing some concerning trends. Clothing prices jumped over 1% in just 1 month. That's the biggest increase since 2018. Why does this matter? Because the Fed has been trying to bring inflation down for 2 years. They want to cut interest rates to help the economy. But you can't cut rates when oil is spiking and prices are rising. It's like trying to put out a fire with gasoline, so they're stuck. They can't help the stock market without making inflation worse. Meanwhile, the bond market is sending mixed signals. Usually when stocks fall, bonds rise as people look for safety, but that's not happening consistently anymore. 10-year Treasury yields are still above 4%, which means the bond market doesn't trust that inflation is really under control. This breaks the normal playbook where bonds protect you when stocks get volatile. Here's where it gets interesting from a game theory perspective. Bitcoin has been rising while traditional safe havens struggle. It's up over 8 days straight, even as the dollar got stronger and interest rates stayed high. That's not normal behavior for a risky asset during a war. It suggests that some smart money is treating Bitcoin like digital gold, a way to protect wealth when traditional options aren't working. The earnings reports this week will tell us if companies can actually deliver profits in this environment. Micron reports Wednesday and will show us if the AI chip boom is real or just hype. FedEx on Thursday gives us a read on global shipping and trade. If companies start missing expectations while dealing with higher oil prices and uncertain demand, that Monday rally could reverse quickly. What does this mean for anyone watching the markets? The pattern is clear. We're in a period where old rules don't apply reliably. The buy-the-dip strategy that worked for years is running into new obstacles. Energy shocks, stubborn inflation, and central banks that can't just print money to solve problems anymore. The disciplined approach here isn't to predict what happens next. It's to recognize that we're in a transition period where the risks are higher and the rewards are less certain. The traders who survive these periods are the ones who respect the process more than they chase the profits. If you want to understand how to build a systematic approach to reading these market shifts, I break down the complete framework in my free guide. The link is in the description. Subscribe if you value objective analysis over emotional reactions to daily market noise.